Before we get started, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation is not a substitute for professional advice. Always consult with a qualified professional before making any financial decisions. Let me ask you a question. What could you do with an extra $1,388 this year? That's not a random number. According to the latest data, that's the average amount a Florida driver overpays for car insurance compared to the rest of the country. We are number one in the nation for the highest car insurance costs. Not by a little, by a lot. You're not imagining it. That bill you get every 6 months that makes your stomach drop? It's worse here than anywhere else. And the worst part? A huge chunk of that money is being completely wasted on coverage you might not need, discounts you're not getting, and a system that's practically designed to drain your bank account. But what if I told you that you could reclaim a huge portion of that money? Not by switching to some sketchy no-name insurance company, and not by driving a 20-year-old clunker. I'm talking about using insider knowledge to force your current insurance company to give you the rate you actually deserve. For the next few minutes, we're going to pull back the curtain on the Florida car insurance industry. I spent years working on the inside, analyzing risk models and pricing structures for major carriers. I saw exactly how the sausage is made, and trust me, it's not pretty. They rely on you being confused, busy, and too intimidated to ask the right questions. Today that ends. I'm going to arm you with the knowledge, the exact questions, and the step-by-step strategies to systematically lower your premium. By the time this is over, you will be an expert on your own policy, and you will have a clear action plan to save hundreds, maybe even thousands of dollars per year. We're not just scratching the surface with Raise Your Deductible. We are going deep. To win this game, you first have to understand the rules. So the first thing we have to do is answer the big question. Why? Why are you, as a Florida driver, forced to pay so much more than someone in Ohio or Texas? It's not just one thing. It's a perfect storm of 4 major factors, 4 monsters that are eating your money. And understanding them is the first step to starving them. The first and biggest monster is a system called no-fault insurance, and its key component, something called PIP, or personal injury protection. Now stick with me, this is critical. In most states, if someone rear-ends you, their insurance pays for your medical bills and your car repairs. Simple, right? The person at fault pays. But Florida is a no-fault state. It's a completely different game. Imagine you and your neighbor get into a fender bender in your driveway. In Florida, the law basically says, hey, doesn't matter who was at fault. You each take care of your own medical bills first, up to $10,000. That's what your mandatory PIP coverage is for. It pays for 80% of your initial medical bills and 60% of lost wages, up to $10,000, regardless of who caused the accident. On the surface, this was supposed to be a good idea. It was designed to keep small claims out of the courts and get people paid for their injuries quickly. But in reality, it created a monster. It created a system that is disgustingly easy to defraud. Unscrupulous medical clinics and shady lawyers realized they could exploit this. They could stage minor accidents, have people claim fake injuries, and bill insurance companies for the full $10,000 in PIP benefits for treatments that were never needed or never even performed. Think about that. A $10,000 payday for a minor fender bender. This fraud is so widespread in Florida that it has its own name, Fee Mills. And who pays for all that fraud? Every single person with a driver's license in the state of Florida. It's baked right into your premium. You are paying a fraud tax every single time you pay your insurance bill. This leads us directly to the second monster, rampant litigation. The billboard lawyers. You see them everywhere, from the Panhandle to the Keys. Hurt in a crash? Call us. Why is Florida such a paradise for personal injury attorneys? It's a direct result of that PIP system. Remember how PIP only covers the first $10,000 in medical bills? Well, what happens if your injuries are serious? What happens if your bills are $20,000, $50,000, or $100,000? That's when the lawsuits begin. Because the system is so convoluted, it encourages legal battles to determine who pays for what and for how much. Insurance companies have to hire armies of lawyers to defend themselves, and the plaintiff's attorneys are working to get the biggest settlement possible. Every single one of these legal battles, from the smallest settlement to the biggest courtroom verdict, costs the insurance companies money. And what do they do when their costs go up? They raise rates for everyone. They're not going to eat that cost. You are. Your premium is higher because the entire state is trapped in a cycle of endless, expensive litigation. Now let's talk about the third monster, and this one is driving right next to you on I-95. It's the ghost driver, the uninsured motorist. The numbers are staggering. In Florida, nearly 1 in 4 drivers on the road has no car insurance. Let me repeat that. Go outside and count 4 cars. Statistically, one of them is driving illegally, with no coverage to pay for any damage they might cause. This is one of the highest rates in the entire United States. So, when one of those 23% of drivers runs a red light and smashes into you, who pays for your car? Who pays for your medical bills that go beyond your $10,000 PIP limit? You do. Or rather, your insurance company does. Through a coverage called Uninsured Motorist, or UM. This is coverage you are basically forced to buy, not to cover your own mistakes, but to protect yourself and your family from the financial devastation of being hit by someone who broke the law. You are paying extra every single month to clean up the mess made by irresponsible people. It's another hidden tax on the good drivers of Florida. And finally, we have the fourth monster. The one we can't control but we have to pay for, Mother Nature. We live in paradise, but paradise has a price. Every hurricane that makes landfall, every tropical storm that causes widespread flooding, results in tens of thousands of vehicle claims. All those cars sitting in flooded garages in Naples, or crushed by trees in Pensacola. Those are paid for under the comprehensive portion of an auto policy. When a major storm hits, insurance companies have to pay out hundreds of millions, sometimes billions, of dollars in a single event. And just like with litigation, they don't just absorb that loss. The very next year, they recalculate the risk of living in Florida, and comprehensive insurance rates go up for absolutely everyone, whether your car was damaged or not. So let's recap. You're paying a premium because you're forced to buy PIP coverage that's riddled with fraud. You're paying for endless lawsuits fueled by that broken system. You're paying to protect yourself from a massive army of uninsured drivers. And you're paying the hurricane tax for living in a tropical climate. It feels like the deck is stacked against you. And honestly, it is. But knowing why the deck is stacked is the first step to learning how to play the game and win. You now understand the battlefield better than 99% of Florida drivers. You know the 4 great monsters that are eating your money. But here's the secret the insurance companies don't want you to realize. Within that complicated, expensive system, there are levers you can pull. There are trapdoors and secret passages that lead to massive savings. They exist because the system is so complex it has to have flexibility. And we are going to exploit that flexibility. The first and most important lever is your own declarations page. That piece of paper they mail you that you probably file away without a second glance? It's a treasure map. It holds the key to your first $100, $200, maybe even $500 in savings. And in the very next part, I'm going to show you how to read it, not as a customer, but as an insurance insider. We're going to go line by line, and I will expose the hidden areas where you are most likely overpaying. We'll dissect every single coverage, from bodily injury liability to medical payments, and I'll show you exactly where the fat is and how to trim it. Alright, let's grab your policy declarations page. It's that summary sheet that lists all your coverages and their costs. If you don't have it handy, pause this video and pull it up on your phone or computer. Go ahead, I'll wait. Got it? Perfect. Because the first line item we're going to attack is usually the biggest, most misunderstood, and most dangerous part of your policy, bodily injury liability. Now you might be looking at your page and seeing something like 10/20th, or 25/50th, or maybe 100/300. These aren't random numbers. They're the financial limits of your protection, written in thousands of dollars. And understanding what they mean is the first key to unlocking massive savings. Bodily injury liability, or BI for short, does not pay for your injuries. Let me repeat that because it's the #1 mistake people make. Bodily injury liability pays for the injuries of other people if you cause an accident. It covers their medical bills, their lost wages, their pain and suffering. More importantly, it pays for the lawyers who will defend you when you get sued. And in a state as litigious as Florida, believe me, you will get sued. Think of it as your financial shield. If you cause a crash and someone gets hurt, they're not just coming after your insurance company. They're coming after you. They're coming after your car, your savings account, your house, even your future wages. This coverage is the only thing standing between a simple mistake on the road and total financial ruin. So let's decode those numbers. When you see something like 25/50th, it's what we call a split limit. The first number, the 25, represents $25,000. That is the absolute maximum your insurance company will pay out for any one single person's injuries in an accident you cause. The second number, the 50, represents $50,000. That's the maximum total your policy will pay out for all people combined in that same accident. So if you cause an accident and injure 3 people, the most your insurance will pay is $50,000 total, with no single person getting more than $25,000. Anything above that comes directly out of your pocket. Now here is the first dirty secret of the Florida insurance market. Technically, in Florida, you are not required by law to carry bodily injury liability insurance at all to register your car. I know it sounds insane, but it's true. The state minimum requirements are focused on property damage and personal injury protection, which we'll get to. Because of this, many agents, especially those at the big call centers, will sell you a policy with the absolute bare bones minimums, or even no BI at all, just to give you the cheapest possible quote and make a quick sale. This is, without a doubt, the single most dangerous financial decision a Florida driver can make. It is playing Russian roulette with your entire financial future. Carrying the state minimums in Florida is like going into a sword fight with a plastic butter knife. Let me paint you a picture. Let's say you have a 10/20ths policy. $10,000 per person, $20,000 per accident. You're driving down I-95, you glance down at your phone for just a second, and you rear-end a minivan with a family of 4 inside. It's a moderate impact, but the mom gets a bad case of whiplash, the dad breaks his wrist, and one of the kids has a concussion. The mom's initial ambulance ride and emergency room visit alone could be over $10,000. Her follow-up doctor visits, physical therapy, and lost wages from her job could easily hit $30,000 or $40,000. The dad's broken wrist requires surgery, costing $20,000. The child's concussion requires scans and monitoring, another $5,000. So let's tally that up. We have a $40,000 claim for the mom, a $20,000 claim for the dad, and a $5,000 claim for the child. That's $65,000 in medical bills and damages. Now let's look at your 10/20ths policy. Your insurance company will pay the mom her limit of $10,000. They'll pay the dad his limit of $10,000. But wait, that's your per accident limit of $20,000 used up right there. The child gets nothing from your insurance. So, who pays the remaining $55,000? You do. The family's attorney will sue you personally. They will get a judgment against you. They will garnish your wages, taking a percentage of every paycheck you earned for years. They will put a lien on your house. They will seize your bank accounts. Your life as you know it is over, all because you tried to save $20 or $30 a month on your car insurance. Are you starting to see why this is so critical? The goal isn't to find the cheapest policy. The goal is to find the smartest policy that gives you the most protection for the least amount of money. So how do you find that sweet spot? The Goldilocks zone? It's actually pretty simple. You need to match your bodily injury limits to your net worth. Look at everything you own. The equity in your home, your savings, your retirement accounts, your investments. Add it all up. That number is what you stand to lose in a lawsuit. Your liability coverage should, at a minimum, be equal to that number. For most people starting out, a 25/50 policy is the absolute non-negotiable minimum you should even consider. It's not great, but it's a basic level of defense. If you're a homeowner, or have any significant savings, you should be looking at 100/300 as your starting point. That's $100,000 per person, $300,000 per accident. For many middle-class families in Florida, this is the sweet spot. It provides a robust shield that will satisfy most claims without breaking the bank. If you have a higher net worth, say over $300,000, you should be looking at 250/500 limits. And here's a pro tip. Once you get to that level, you should also be asking your agent for a quote on a separate umbrella policy. An umbrella policy is a cheap way to add an extra $1 million or more in liability coverage over and above what your auto policy provides. Sometimes it's actually cheaper to get a $250,500 policy plus a $1 million umbrella than it is to get a $500,500 auto policy by itself. So here's your action item for this section. Look at your policy right now. If you have 10/20ths or God forbid, no bodily injury coverage at all, you need to call your agent today and get it increased. Don't wait. The cost difference to go from a dangerously low 10/20ths to a respectable 100 to 300 is often less than you think. It might be $40, $50, maybe $60 a month, but that $60 buys you $300,000 of protection instead of $20,000. There is no better return on investment for your peace of mind. Ask your agent to quote you at several levels: 25/50ths, 50/100, 100/300, and 250/500. Look at the price difference between each tier. You'll often find that the jumps in price get smaller as the coverage gets higher. The jump from 10/20ths to 25/50ths might be significant, but the jump from 100/300 to 250/500 might be surprisingly small. This is where you find the value. Now look at the next line on your policy. It's probably property damage liability. This one's a bit more straightforward. It pays to repair or replace the other person's car or property if you cause an accident. If you hit a brand new Mercedes, this is the coverage that pays for it. If you swerve off the road and take out someone's expensive mailbox and landscaping, this pays for it. The state minimum for property damage in Florida is a laughable $10,000. $10,000. Have you seen the price of cars lately? The average new car costs nearly $50,000. Even a minor fender bender with a Tesla can result in a $20,000 repair bill because of all the sensors and electronics. $10,000 is nothing. It's a joke. If you have the state minimum and you total someone's Honda Civic, you're already in debt. My rule here is simple and non-negotiable. You need a minimum of $50,000 in property damage liability, the absolute minimum. $100,000 is even better, and the cost to go from 50 to 100 is usually pennies on the day. It's one of the cheapest coverages to increase and one of the most important. Check your policy now. If it says $10,000, you have your next phone call to make. So we've fixed the two biggest liability risks on your policy. We've built a strong financial fortress around you and your assets. But we're just getting started. The next few lines on your policy are where the insurance companies really start to play games. This is where they hide the fees and sell you coverages that sound good, but are often redundant or just plain useless. And the very next one is the most confusing of all for Floridians. Personal injury protection, or PIP. This is the heart of Florida's no-fault system, and it is a minefield of misinformation. There is a multi-billion-dollar industry built around exploiting this one single coverage, and there's a 99% chance that the way you have it set up right now is costing you money and leaving you exposed. In the next part, we are going to unravel the PIP scam, and I will show you the one simple change you can make that will slash your premium while actually giving you better coverage in a real emergency. You don't want to miss this. So let's pull back the curtain on what is, without a doubt, the biggest legalized racket in the state of Florida: personal injury protection, or PIP. This is the no-fault part of your insurance. The original idea decades ago was simple. If you get into a minor accident, instead of suing each other for years, your own insurance company would pay the first $10,000 of your medical bills. It sounds good on paper, right? It was supposed to speed up payments and clear the courts. But in reality, it has morphed into a monster. A fraud factory. It's become a system that enriches shady clinics and billboard attorneys while providing almost zero real benefit to you, the person paying for it. In fact, it's one of the single biggest reasons your insurance rates are astronomical. You are paying a massive tax for a benefit that, in most cases, you will never truly get to use. Here's how the scam works. You get into a minor fender bender. Your neck is a little sore. The next day, you get a call from a clinic or a referral service. How did they get your number so fast? Let's just say the system is very efficient. They tell you to come in for a checkup. It's all covered by your PIP, no cost to you. You go in. They do some x-rays, give you some physical therapy, maybe some heat packs. You do this for a few weeks. Then the bills start rolling in. That initial visit? $1,000. Each therapy session? $300. Suddenly, that $10,000 of coverage you paid for is gone. Evaporated. It's been completely eaten up by the clinic. And here's the kicker. If you were actually hurt, that $10,000 is now gone, and you're left to deal with your real medical bills on your own. The system designed to help you has been bled dry before you could even use it for a real emergency. The state of Florida knows this is happening. They've tried to fix it. They implemented a rule that you have to seek treatment within 14 days of an accident, or your PIP won't pay. What happened? The fraudulent clinics just got faster at calling you. Then they implemented another rule. To get the full $10,000, a doctor has to declare you have an emergency medical condition. Otherwise, you only get $2,500. What happened? Miraculously, almost every single person who walks into one of these clinics is diagnosed with an emergency medical condition. It's a joke. The entire system is a game of cat and mouse, and you are the cheese. You are being forced by law to pay hundreds, sometimes thousands of dollars a year for this mandatory coverage that primarily benefits a cottage industry of fraudsters. It is a tax on driving in Florida. So how do you fight back? How do you stop paying for this broken system? This is the simple change I promised you. It's a change that your insurance agent will almost never recommend because it goes against their standard script. You are going to raise your PIP deductible. I want you to log into your insurance policy online or call your agent and ask for one thing: a $1,000 PIP deductible. For most policies, the default is a $0 deductible. By choosing a $1,000 deductible, you are telling the insurance company that you will be responsible for the first $1,000 of your own medical bills in an accident. Now I know what you're thinking. Why would I want to be on the hook for $1,000? Isn't the point of insurance to pay for everything? That is the mindset the system wants you to have. But let's think this through like a strategist. First, the immediate savings are massive. Adding a $1,000 PIP deductible can slash your premium by anywhere from $300 to over $500 per car per year. If you have 2 cars, you could be saving $1,000 right now with one phone call. That's a huge immediate win. Second, and this is the beautiful part, you make yourself an unattractive target for the fraudsters. Think about it. When those shady clinics get your name, the first thing they do is check your insurance. If they see you have a $0 deductible, you are a walking ATM. They know they can bill your insurance directly and get paid easily. But if they see you have a $1,000 deductible, that means they have to try and collect that first $1,000 from you. That's a hassle. It's paperwork. You might argue the bill. You might not pay. Suddenly, you're not easy money anymore. They are far more likely to just move on to the next person on their list with a $0 deductible. You have effectively opted out of their scam. But the most important reason to do this is about protecting yourself from financial ruin. Let's be brutally honest. That $10,000 in PIP coverage is a drop in the bucket in a serious accident. A single night in the hospital can cost more than that. It provides a dangerous, false sense of security. Your real financial protection comes from your health insurance. For the vast majority of people with a decent health plan, your health insurance is going to cover you far better than PIP ever could. So why are you paying a fortune for this redundant, easily scammed $10,000 policy? It makes no sense. You're paying twice for the same thing. By taking the $1,000 PIP deductible, you are making a calculated bet. You're betting that you can cover a small $1,000 medical expense out of pocket, or more likely, have your excellent health insurance cover it, in exchange for saving $500 in cash every single year. You are trading a small, manageable risk for a guaranteed massive reward. You use those savings to pay other bills, invest, or better yet, buy the insurance coverage that actually matters, which we'll get to. Now there's one more crucial piece to this strategy. When you're talking to your agent, after you've asked for the $1,000 deductible, you need to ask them to make sure your PIP is set to primary, sometimes called non-coordinated. This sounds technical, but it's incredibly important. The default on many policies is coordinated, which means your health insurance is expected to pay first in an accident. You do not want that. You want your PIP to be primary. This forces your auto insurance company, the one you're paying for accident coverage, to be the first in line to pay that bill up to its limit. Why is this so powerful? Because it means your car insurance pays your $1,000 deductible for your health insurance. Let me say that again. If you have an accident and your health insurance has a $5,000 deductible, your car insurance's PIP will pay the first chunk of your medical bills. That payment is then credited toward your main health insurance deductible. You are using the money you pay for car insurance to satisfy the deductible on your health insurance. It's a brilliant way to make 2 policies work together to save you thousands of dollars in a real emergency. So let's recap the play. Step 1. Change your PIP deductible to $1,000. This saves you a ton of money and makes you invisible to the fraudsters. Step 2. Ensure your PIP is set to primary or non-coordinated. This forces your car insurance to pay first and helps satisfy your health insurance deductible for you. This single strategy turns PIP from a useless, expensive tax into a smart, strategic tool that actually works for you, integrates with your health insurance, and saves you hundreds of dollars. We have just fixed the most broken piece of your policy and put a significant amount of money back in your pocket. But saving money is only half the battle. The other half is making sure you aren't one car accident away from total financial annihilation. Because we have to talk about the single most dangerous, most misunderstood coverage of all. The one that, shockingly, isn't even required by Florida law. But going without it can bankrupt you, cost you your house, and ruin your life forever. In the next part, we're going to talk about bodily injury liability and why the state minimums are a trap designed to destroy your financial future. Bodily injury liability, or BI, is the single most important coverage on your auto insurance policy, and it's the one most likely to either save you from ruin or plunge you into a financial nightmare from which you will never recover. And here's the craziest part. In the state of Florida, it's not even required. That's right. You can legally drive on Florida roads without a single penny of coverage to pay for the injuries you might cause to another human being. This is absolute insanity. It's a loophole big enough to drive a semi-truck through. And every single day, people's lives are destroyed because of it. Now you might be thinking, okay, but my policy has it. I'm covered. But are you really? Let's talk about the trap. The trap is the state financial responsibility minimum. This law says that if you cause an accident with injuries, you need to prove you have at least $10,000 per person and $20,000 per accident in bodily injury liability coverage. So, insurance companies, in their infinite wisdom, sell policies with exactly that, 10/20ths limits. It's cheap. Feels like you're saving money. It feels like you're following the rules. But what you're actually doing is buying a ticket to financial oblivion. Let me tell you about a guy we'll call Mark. Mark is a good guy. He works hard at his job in construction. He's got a wife, 2 kids, and a small house in a suburb of Tampa. He's trying to do the right thing, trying to save a little money where he can. Groceries are expensive. The mortgage isn't getting any smaller. So when his insurance renewal came up, he saw an option to save about $30 a month by choosing the basic bodily injury coverage, the 10/20ths limit. It met the state requirement. His agent said it was fine, so he took it. He felt smart. He felt responsible. One Tuesday afternoon, Mark is driving home from a job site. He's tired. He's thinking about dinner. He glances down for just a second to change the radio station. In that 1 second, traffic ahead of him slams on the brakes. He looks up, but it's too late. The sickening crunch of metal echoes through his car as he rear-ends a minivan. It wasn't a high-speed crash. Nobody seemed seriously hurt at first. The woman driving the minivan, a schoolteacher named Sarah, complained of some neck pain. Her son in the backseat was shaken up but seemed okay. They exchanged information, the police came, wrote a report, and everyone went home. Mark felt terrible, but he thought, that's what I have insurance for. A week later, the phone calls started. First, from Sarah's insurance company. Then, a few weeks after that, a thick manila envelope arrived in the mail. It was from a law firm. Mark's heart sank as he read the words. Lawsuit? Negligence, damages. Sarah's neck pain wasn't just whiplash. It was a herniated disc. She needed physical therapy, injections, and eventually surgery. Her son, it turned out, had a concussion that was causing lingering headaches and focus issues at school. The initial ambulance ride and emergency room visit alone cost over $15,000. The surgery for Sarah's neck was projected to be over $80,000. Add in months of lost wages because she couldn't teach, plus pain and suffering, and the total claim against Mark was quickly approaching $250,000. Mark called his insurance company, a knot of dread tightening in his stomach. The claims adjuster was polite, but the news was cold and brutal. Mr. Smith, she said, your bodily injury liability limit is $10,000 per person. We will offer the full $10,000 to the claimant, Sarah. But that is the extent of our liability. You will be personally responsible for the remainder. Mark was speechless. $10,000? That didn't even cover the ER visit. He had saved $30 a month, $360 a year, and in exchange he was now on the hook for $250,000. The lawsuit proceeded. The court found him at fault. It was a clear rear-end collision. They placed a lien on his house. They began garnishing his wages, taking a chunk of his paycheck every single week before he even saw it. The life he had built, the small piece of the American dream he had carved out in that Tampa suburb, was gone. Wiped out. Not by a hurricane or a stock market crash, but by a 1-second glance at a car radio and an insurance policy that was designed to fail. This story isn't an exaggeration. It happens every single day in Florida. $10,000 is a joke. It's an insult. A simple broken arm can cost more than $10,000 to treat. A 3-day hospital stay can cost $30,000. A serious, life-altering injury? You're talking hundreds of thousands, if not millions of dollars. So what is the right amount? This is where we stop the bleeding and get smart. This is how you protect yourself. For bodily injury liability, you will see 2 numbers. For example, 100/300. The first number is the maximum amount your insurance will pay for any single person you injure. The second number is the maximum total amount your insurance will pay for the entire accident. no matter how many people are injured. So, if you have 100-300 coverage and you injure 3 people, person A has $120,000 in medical bills. Your policy will pay up to the per-person limit, which is $100,000. You are now personally on the hook for the remaining $20,000. Person B has $70,000 in bills. Your policy pays the full $70,000 because it's under the $100,000 limit. Person C has $50,000 in bills. Your policy pays the full $50,000. Now we look at the second number, the per-accident limit of $300,000. The total paid out was $100,000 plus $70,000 plus $50,000. That's $220,000. Since that's less than the $300,000 total limit, you're covered for that amount. But you are still getting sued for that extra $20,000 from person A that wasn't covered. So what's the magic number? For any person who owns a home or has any significant savings or assets, the absolute bare minimum you should even consider is $100/300. $100,000 per person, $300,000 per accident. This is the starting point for responsible coverage. It provides a meaningful buffer against the average accident. The smart money, the level that provides real peace of mind, is $250/500. $250,000 per person, $500,000 per accident. Why? Because in today's world of inflated medical costs and aggressive litigation, a serious accident can easily reach these figures. This is the level of coverage that protects your house. It protects your retirement savings. It protects your kids' college funds. It protects your entire future from being wiped out by one bad moment on I-4. But wait, you're saying, this video is about lowering my costs. You're telling me to spend more money. Yes, I am. And this is the most important lesson you will learn. The goal is not to have the cheapest possible insurance bill. The goal is to have the lowest possible total cost of risk. Mark saved $360 on his premium and it cost him his house. His total cost of risk was catastrophic. Spending an extra, say, $40 or $50 a month to go from a worthless 10/20ths policy to a protective $250/500 policy isn't an expense. It's the single greatest financial investment you can make. It's buying a firewall for your life. You don't save money by buying a cheap parachute. The money you spend on adequate bodily injury liability is not money you are losing. It is money you are using to build a fortress around everything you've ever worked for. We will find other ways to lower your premium in the coming parts, through discounts, through smart choices on other coverages. But this is the one place you cannot cut corners. This is the foundation of your entire policy. We've just spent all this time talking about the damage you can do to someone else, and how to protect your assets from them. But what happens when the tables are turned? What happens when someone with no insurance, or with one of those worthless 10/20ths policies smashes into you? Who pays for your medical bills? Who pays for your lost wages? Who fixes your life? Because in Florida, the odds are terrifyingly high that the person who hits you will have little or no coverage to pay for the damage they cause. In the next part, we're going to talk about the single most important coverage for protecting you and your family: uninsured motorist coverage. Uninsured motorist coverage is not just another line item on your policy. It's a financial life raft in a state with an ocean of uninsured drivers. Let me paint you a picture. You're driving on I-75 heading home from work. The sun is setting. You're thinking about dinner. Suddenly, out of nowhere, a car blows through a red light and T-bones you. The impact is violent. Your car is totaled, and you're seriously hurt. After the ambulance ride and the initial shock wears off in the emergency room, you learn 2 things. First, you have a broken leg, 3 fractured ribs, and a severe concussion that will keep you out of work for months. Second, the driver who hit you, the one who was texting and driving, the one who caused all of this, has no bodily injury liability insurance. 0. Not the state minimum. Nothing. He was driving illegally, and now he has vanished into the system, leaving you with the wreckage. So what happens now? Who pays for the $100,000 hospital bill? Who pays for the orthopedic surgeon, the follow-up visits, the months of painful physical therapy? And more importantly, who replaces your paycheck for the next 6 months while you're unable to work? Your health insurance might cover a portion of the medical bills after you meet your huge deductible and pay your copays, but they won't pay for everything. And they certainly won't give you a dime for your lost income. They won't compensate you for the chronic pain you now have to live with, or the fact that you can no longer pick up your kids or enjoy the hobbies you once loved. You're facing financial ruin because of someone else's irresponsibility. This is not a scare tactic. This exact scenario plays out every single day on Florida's roads. This is where uninsured motorist coverage, or UM, comes in. It is your personal financial bodyguard. Think of it this way: when you buy UM, you are buying an insurance policy for the other guy, in case the other guy didn't buy one for himself. Your own insurance company steps into the shoes of the at-fault, uninsured driver and pays you for everything you would have been entitled to collect from them if they had been responsible enough to carry insurance. And this is the part that is absolutely critical to understand. Uninsured motorist coverage pays for the things that no other coverage does. It pays for your medical bills, yes, but it also pays for your lost wages, both past and future. If you can't go back to the same job and have to take a lower paying one, it can cover that difference. Most importantly, it is the only coverage that compensates you for the human cost of a crash. Pain, suffering, mental anguish, disfigurement, and the loss of enjoyment of life. These are not small things. In a serious injury claim, this pain and suffering component can be the largest part of your financial recovery, and without UM, that recovery is zero. Now, when you select UM coverage, your agent will present you with a choice that sounds like confusing insurance jargon, but it is one of the most important financial decisions you will ever make. They'll ask, do you want stacked or non-stacked coverage? Most people have no idea what this means, so they just pick the cheaper option, which is almost always a catastrophic mistake. Let me break this down so simply you'll never forget it. Let's say you have 2 cars in your household. You buy $100,000 of UM coverage. If you choose NO and stacked coverage, that $100,000 is tied to a specific car. It's like buying a single high-powered fire extinguisher and keeping it in your living room. If a fire breaks out in the living room, you're covered. You have that one extinguisher to use, but you only get to use that one. The limit is $100,000, period. Now let's look at stacked coverage. Using the same example, you have 2 cars and you buy $100,000 of UM coverage. Because you chose stacked, it's like buying a separate fire extinguisher for each car you own. If a fire breaks out in your house, you are allowed to grab both fire extinguishers and use them on that single fire. So, your $100,000 of coverage on car 1 gets stacked, on top of the $100,000 of coverage on car 2. Suddenly, you have $200,000 of available coverage for that single accident. If you have 3 cars, you'd have $300,000. It multiplies your protection. But here is the most incredible part about stacked coverage, the part that makes it the best deal in insurance. Stacked UM coverage follows you, not the car. It protects you and your resident family members no matter where you are. You could be a passenger in your friend's Uber. You could be hit by a car while riding your bicycle. You could be a pedestrian crossing the street. If an uninsured driver injures you in any of those situations, your stacked UM coverage from your own auto policy kicks in to protect you. It's a suit of financial armor that you wear everywhere you go. Non-stacked coverage doesn't do that. It's far more restrictive. People look at their quote and see that stacked coverage costs a little more, maybe $20 or $30 a month, and they think they're saving money by rejecting it. This is a classic case of being penny-wise and pound-foolish. The difference in premium is minuscule compared to the massive, life-altering difference in protection. Having $100,000 in coverage versus $200,000 or $300,000 can be the difference between a full recovery and a lifetime of debt and struggle. So when we talk about how to lower your car insurance costs, we have to talk about value, not just price. The goal is to lower your total financial risk. Paying a slightly higher premium for stacked UM coverage is the single most effective way to eliminate the risk of a multi-$100,000 loss caused by someone else. Think of it as an investment, not an expense. Rejecting this coverage to save a few $100s a year is like canceling your health insurance to save money right before you get a major diagnosis. The short-term savings are obliterated by the long-term catastrophe. Before you make any other changes to your policy, I want you to pull it out right now and look for 2 words: stacked or non-stacked. If you see non-stacked, or if you see that you've rejected UM coverage entirely, your very next phone call should be to your insurance agent to change it. Today, it is that important. It is the one coverage that protects you from the biggest financial threat on Florida's roads: the person driving next to you. Now, uninsured motorist coverage is a miracle for covering your injuries, your lost wages, and your suffering. But you'll notice it does nothing to fix your car. If an uninsured driver totals your brand new SUV, UM won't pay a penny to repair or replace it. For that, you need a different kind of coverage, and understanding how to use it, and more importantly, how to choose the right deductible, is the next major secret to balancing protection with a lower premium. That coverage is collision, and we're going to break it down next. Collision is the coverage that pays to repair or replace your own car. After an accident where you are at fault, let's paint a picture. You're leaving the mall in Boca Raton. You misjudge the distance to a concrete pillar in the parking garage, and you hear that gut-wrenching crunch of metal. Your property damage liability? That doesn't help you. It's for the damage you do to other people's property, like that concrete pillar. Your personal injury protection? That's for your medical bills if you get hurt. The only thing that's going to fix your crumpled bumper and smashed headlight is collision coverage. It also kicks in if you're the victim of a hit and run, or if you're hit by a driver who, believe it or not, has no insurance at all, which is a terrifyingly common scenario here in Florida. So, to be crystal clear, if you cause an accident, your property damage liability pays for the other car. Your collision coverage pays for your car. It's that simple. And because it covers your own vehicle, which could be a brand new 20, 50, or even $100,000 asset, this coverage can be expensive. But here's the secret. You have almost complete control over how expensive it is. And that control comes down to one single powerful number, your deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before your insurance company pays a single dollar. Think of it like a copay for your car. If you have a $500 deductible and you get into an accident that causes $3,000 in damage to your car, you pay the first $500, and the insurance company covers the remaining $2,500. If the damage is only $400, you're on your own. The insurance doesn't get involved because the cost is less than your deductible. Now, here is the golden rule of insurance premiums. The higher your deductible, the lower your monthly premium will be. And the difference isn't trivial. Moving your deductible from $250 to $500 could save you a decent amount. But moving it from $500 to $1,000? That can often result in savings of up to 40% or more on your collision premium. Moving it to $1,500 or even $2,000 can save you even more. The insurance company sees a high deductible as a sign that you are a lower risk. You're less likely to file small, piddly claims for every little scratch and ding, and you're willing to share more of the financial burden in a major accident. They reward this shared risk with a significantly lower price. So the obvious answer is to just crank your deductible up to the maximum, right? Not so fast. This is where financial responsibility meets insurance strategy. Choosing the wrong deductible can be a catastrophic mistake. The single most important question you must ask yourself is this: how much cash can I comfortably access right now without causing a financial crisis in my life? Your deductible should never, ever be higher than the amount in your emergency fund. If you have a $1,000 deductible to save $40 a month, but you only have $300 in savings, you haven't saved money. You've set a trap for yourself. That first accident will force you into debt, putting the repair on a high-interest credit card, completely wiping out years of premium savings in an instant. The smart move is to align your deductible with your reality. If you have a solid emergency fund of $2,000 or more, then a $1,000 or even a $1,500 deductible is a brilliant financial strategy to slash your premiums. If you're still building your savings, a $500 deductible might be the safer, more responsible choice for now. But there's a second, equally important factor to consider: the value of your car. This leads us to one of the biggest money-saving moves you can make, one that many people overlook for years. You need to ask yourself, is it even worth having collision coverage at all? Insurance is designed to protect you from a devastating financial loss, not a minor inconvenience. If you're driving a 15-year-old car that's worth, say, $3,000, does it make sense to pay $600 a year for a collision policy with a $1,000 deductible? Let's do the math. In a worst-case scenario, your car is totaled. The insurance company cuts you a check for its value, which is $3,000, but only after you pay your $1,000 deductible. So, your net payout is just $2,000. You've been paying $600 a year for the privilege of receiving a $2,000 check in a total loss event. Is that a good return on your investment? For many, the answer is no. Here's a powerful rule of thumb many financial experts use: the 10% rule. If the annual cost of your collision coverage is more than 10% of your car's actual cash value, you should seriously consider dropping it. First, find your car's value. Go to Kelley Blue Book, KBB.com, and get a realistic private party sale value for your car in its current condition. Let's say that value is $4,000. Now look at your insurance policy declaration page. Find the line item for collision coverage and see what it costs you per year. If it's $400 or less, you're at or below that 10% threshold, and it's probably worth keeping. But if you're paying $500 or $600 a year for it, that's 12 to 15% of your car's total value. At that point, you might be better off self-insuring. That means dropping the coverage, taking that $500 you're saving, and putting it into a dedicated high-yield savings account for car repairs or a down payment on your next vehicle. Over a few years, you'll have saved enough to cover most potential repairs or even replace the car entirely, without ever having to file a claim that could raise your rates. This is especially true if you have that solid emergency fund we talked about. If you have the cash on hand to repair or replace your older car without insurance, you are essentially paying an insurance company for peace of mind you don't really need. By dropping collision on an older car, you are taking a calculated risk, but you're betting on yourself. You're betting that your safe driving will save you more money in the long run than the insurance policy would. For thousands of Floridians driving older, paid-off cars, this single move can cut their insurance bill by hundreds, sometimes even over $1,000 a year. It is the definition of a power move. So your action item is this: find your car's value, find the annual cost of your collision coverage, and do the math. Then, look at your emergency fund and decide on a deductible that reflects your true financial situation, not just the lowest possible monthly payment. By strategically choosing your deductible and knowing when to walk away from the coverage altogether, you take back control. Now, collision covers damage from, well, a collision, hitting another car, a pole, a guardrail. But what about all the bizarre, unpredictable things that can happen to your car when you're not even driving it? A falling coconut from a palm tree in a Key West parking lot, a rogue shopping cart at the grocery store, a flash flood from one of our afternoon thunderstorms, or waking up one morning to find your car stolen from your driveway. These events have nothing to do with your driving skills, and collision coverage won't help you at all. That's a whole different ballgame, a different kind of risk that requires a different kind of coverage. And that's where comprehensive coverage comes in, which is exactly what we're tackling next. Think of it this way: collision is for when your car hits something. Comprehensive is for when the world hits your car. It's the coverage for all the bizarre, unpredictable, and downright wild things that can happen, especially here in the Sunshine State. It's for the stuff that has absolutely nothing to do with your driving skills. We're talking theft, vandalism, fire, falling objects, and the big ones for us in Florida: hurricanes, hail, and floods. Comprehensive is your financial shield against what the insurance world sometimes calls acts of God. And in Florida, it feels like God is a little more active than in other places. Let me paint you a picture. It's late August. A tropical storm that was barely a blip on the radar 3 days ago has exploded into a Category 3 hurricane, and it's churning right for the coast. You've boarded up your windows, stocked up on water, and moved your car to what you hope is higher ground. The storm hits. The wind howls like a freight train for 8 straight hours. The next morning, you step outside. Your roof is okay, the power is out, but you're safe. But then you look down the street to where you parked your car. It's not just in a puddle. It's sitting in 3 feet of salt water. The engine is flooded, the electronics are fried, the interior is ruined. It's a total loss. Without comprehensive coverage, you are looking at a $10,000, $20,000, $30,000 piece of scrap metal. You're starting from zero. With comprehensive coverage, you make a phone call, you pay your deductible, and you get a check for the actual cash value of your car, allowing you to get back on your feet and back on the road. That is the power and the peace of mind that comprehensive provides. It's not about if you're a good driver. It's about acknowledging that we live in a place where nature can and will throw a punch. And it's not just hurricanes. Think about the common, everyday Florida risks. You park at the mall in Miami, you come out, and your window is smashed, your stereo gone. That's comprehensive. You're driving down I-4 at night and a deer bolts out of the woods. Hitting an animal is not a collision in the eyes of insurance. It's a comprehensive claim. A severe thunderstorm rolls through Tampa, and a massive oak limb cracks and crashes down on your hood. Comprehensive. A hailstorm in Orlando leaves your car looking like a golf ball. Comprehensive. Even the truly weird Florida stuff, like a flock of vultures deciding your car's rubber seals look delicious. Yes, that really happens, that's a comprehensive claim. Or the infamous frozen iguanas falling out of trees during a cold snap and cracking a windshield. It sounds like a joke until it's your windshield. So, if comprehensive is so important, how does this fit into our goal of lowering our insurance costs? Seems counterintuitive. I'm telling you about all these risks that require more coverage. But this is where the strategy comes in. Understanding comprehensive allows you to control its cost. The 2 main levers you can pull are your deductible and your decision to carry the coverage at all. First, let's talk about the deductible. Just like with collision coverage, your comprehensive deductible is the amount you pay out of pocket before the insurance company pays the rest. And just like with collision, a higher deductible means a lower premium. Insurers often set a default comprehensive deductible at $500, but you can ask to raise it to $1,000 or even $2,000. The question you have to ask yourself is, what is my risk tolerance for a non-driving related event? For a minor claim like a cracked windshield, many Florida policies actually have a $0 deductible for glass repair anyway, so a higher overall deductible might not even affect that. But for that tree limb or that vandalism claim, you'd be on the hook for the first $1,000 instead of $500. In exchange, you could be saving a significant amount on your premium every 6 months. You're essentially self-insuring for the small stuff to get a discount on the big stuff. It's a calculated risk, but for many people, especially those who park in a secure garage and have a good emergency fund, it's a smart financial move. But the biggest money-saving question you can ask about comprehensive coverage is the most radical one. Do I even need it? And the answer to that question comes down to 3 things. Do you have a loan? What is your car worth? And what is your personal financial situation? First, the loan question. This one is simple. If you are leasing your car or you have a loan on it, the answer is yes, you need comprehensive coverage. Period. Your lender requires it. They have a financial stake in that vehicle, and they will mandate that you carry both collision and comprehensive to protect their investment until the loan is paid off. Trying to drop it would violate your loan agreement. So, if you're making payments, this part of the conversation isn't for you just yet. But if you own your car outright, you are in the driver's seat. You get to make the call. And this is where you need to become your own financial analyst. The key is to weigh the cost of the coverage against the value of your car. Let's say you're driving a 12-year-old Toyota Camry. It's reliable, it's paid off, but it's not worth a fortune. The first thing you need to do is find its actual cash value, or ACV. Don't guess. Go to Kelley Blue Book, go to Edmunds, put in your car's mileage, condition, and options, and get a realistic private party sale value. Let's say it's worth $5,000. Now, look at your insurance policy. How much are you paying specifically for comprehensive coverage per year? It's listed right there on your declarations page. Let's say it's $300 a year, and your deductible is $500. So here's the math. If your car gets stolen or totaled in a flood, the absolute maximum payout you will receive from your insurance company is the car's value minus your deductible. In this case, $5,000 minus your $500 deductible, which is $4,500. So you are paying $300 a year to protect yourself from a potential $4,500 loss. Is that worth it? For many, the answer is yes. But what if the numbers were different? What if your car is only worth $2,500? Now, your maximum payout is only $2,000 after the deductible. You're still paying $300 a year for that protection. You would have to pay that premium for nearly 7 years before it would equal the amount of a potential payout. At this point, the math starts to get a little shaky. You might be better off dropping comprehensive, taking that $300 you save every year, and putting it into a separate savings account specifically for car repairs or a down payment on your next car. This is what's called self-insuring. You are accepting the risk yourself instead of paying a company to accept it for you. The general rule of thumb many financial experts use is this. If the annual cost of your comprehensive and collision coverage is more than 10% of your car's value, it's time to seriously consider dropping them. In our example, if your car is worth $2,500, 10% of that is $250. If your comprehensive coverage alone costs $300, you're already past that threshold. This decision is deeply personal. If that $2,500 car is your only way to get to work, and you have zero savings to replace it if it gets stolen, then paying for comprehensive might be the peace of mind you absolutely need. But if you have a healthy emergency fund, and losing that car would be an inconvenience but not a financial catastrophe, then dropping the coverage and banking the savings could be the smarter long-term play. It's about being brutally honest about your car's value and your own financial safety net. You're moving from just being a car owner to being a risk manager for your own life. This is the kind of strategic thinking that separates people who just pay their insurance bill from people who actively manage and reduce it. It's not about being cheap. It's about being smart. It's about understanding that insurance isn't a one-size-fits-all product. It's a tool, and you need to know which parts of that tool are serving you, and which parts are just costing you money for a level of protection you may no longer need. We've covered the risks you pose to others with liability. We've covered protecting your car from your own driving mistakes with collision. And now we've covered protecting your car from the world with comprehensive. But there's a massive glaring risk we haven't talked about yet. It's a risk that is terrifyingly common here in Florida. What happens when someone else hits you? It's their fault, but they don't have insurance. Or they don't have enough insurance to cover your medical bills. That's where you are dangerously exposed, and it's a gap in your armor that you absolutely need to fill. This gap is filled by what might be the single most important coverage you can buy in the state of Florida. Yet it's the one most people reject to save a few dollars a month. I'm talking about uninsured and underinsured motorist coverage, or for short. Let me tell you a story. It's about a nurse from Tampa named Brenda. Brenda did everything right. She drove a safe car, never texted while driving, and paid her insurance premium on time, every month for 12 years. One Tuesday afternoon, she was driving home from a long shift at the hospital, sitting at a red light on Dale Mabry, thinking about what to make for dinner. The light turned green. She proceeded through the intersection, and then wham! A pickup truck, flying through the red light, T-boned her driver's side door at 50 miles per hour. The crash was catastrophic. Brenda survived, but with a shattered pelvis, a traumatic brain injury, and a long painful road to recovery ahead of her. She would be out of work for at least a year. The medical bills started coming in almost immediately. The ambulance ride, the emergency room, the trauma surgeons, the ICU stay. Within the first week, her bills had already blown past $100,000. Her $10,000 in PIP coverage? That was gone in the first few hours. It was like trying to put out a forest fire with a water pistol. But Brenda thought, it's okay. It wasn't my fault. The other driver's insurance will have to cover all of this. Her lawyer made the call, and the news came back like a punch to the gut. The driver of the pickup truck had no bodily injury liability insurance. Zero. He was driving illegally, with a suspended license and the absolute bare minimum coverage Florida law required, which meant he had nothing to pay for Brenda's injuries. Nothing for her medical bills, nothing for her lost wages, nothing for the permanent limp she would now have for the rest of her life. He had no assets to his name. Suing him would be like trying to get blood from a stone. So after 12 years of faithfully paying her premiums, Brenda was left with hundreds of thousands in medical debt, no income, and a life that was permanently altered, all because of a loophole in Florida's system. She was financially ruined. This isn't a scare tactic. This exact scenario plays out every single day on Florida's roads. Remember, 1 in 5 drivers around you is uninsured. That's a game of Russian roulette every time you get behind the wheel. Now let's rewind Brenda's story. Let's change one single thing. Let's imagine that when Brenda was setting up her policy years ago, her agent asked if she wanted to add uninsured motorist coverage. It would have cost her about $25 more a month. In this version of the story, she says yes. Now fast forward to the crash. The same horrific accident. The same devastating injuries. The same uninsured driver at fault. But this time, the story has a different ending. When her lawyer discovers the other driver is uninsured, it's not a dead end. Instead, he turns to Brenda's own insurance company. Her uninsured motorist coverage steps into the shoes of the at-fault driver. It becomes the insurance that the other guy should have had. If Brenda had chosen coverage of, say, $250,000, her own policy would now pay for her medical bills beyond her PIP, her lost wages from being unable to work as a nurse, and her pain and suffering. It wouldn't undo the crash, but it would prevent the financial ruin. It would give her the resources to heal without the crushing weight of bankruptcy. It would be her financial life raft. That is the power of uninsured motorist coverage. It protects you from the irresponsible choices of others. It's not for them. It's for you and your family. Now, here's where it gets even more critical, and this is a detail specific to Florida that can make a world of difference. When you buy coverage, you will be given a choice: stacked or non-stacked. Most people have no idea what this means, so they just pick the cheaper one, which is almost always non-stacked. This is a massive mistake. Let me break it down. Non-stacked coverage is the simpler option. Let's say you have one car, and you buy $100,000 of non-stacked coverage. If you get hit by an uninsured driver, you have a pool of $100,000 to draw from. Simple. If you have 2 cars, each with $100,000 of non-stacked coverage, you are only covered by the policy of the car you are in at the time of the accident. You still only have access to that $100,000 limit. You can't combine them. Now let's look at stacked coverage. This is where you become your own financial fortress. Stacking means you can combine or stack the coverage limits for each vehicle you own. Let's go back to that example. You have 2 cars and you pay a little extra for stacked coverage of $100,000 on each. Now, if you are in an accident in either of those cars, or even if you're a pedestrian or on a bicycle and get hit by an uninsured driver, you don't just have access to $100,000. You have access to the stacked total. You can add the coverage from both cars together. So $100,000 from car A plus $100,000 from car B gives you a total safety net of $200,000. Have 3 cars. With stacked coverage, your $100,000 limit just became a $300,000 limit. For cars, $400,000. You see how powerful this is? For a relatively small increase in your premium, you can multiply your protection. This is especially critical for underinsured claims. Let's say the at-fault driver isn't completely uninsured, but they only have the minimum bodily injury liability, maybe $25,000. Your medical bills are $200,000. Their insurance pays out their $25,000 limit, and it's gone. You are left with a $175,000 shortfall. If you have that stacked policy of $300,000, your own insurance can then step in and cover that remaining $175,000. With a non-stacked $100,000 policy, you would have been $75,000 in the hole. Rejecting uninsured motorist coverage to save a few bucks is like removing the fire extinguishers from your house to save on maintenance. You won't notice the savings until the day your house burns down. And in Florida, with so many uninsured drivers, the chances of that fire are terrifyingly high. The single best piece of advice I can give anyone driving in this state is to buy as much stacked uninsured motorist coverage as you can possibly afford. It is the only thing that stands between you and financial catastrophe when you're the victim of someone else's recklessness. Go pull out your policy declaration page right now. Find the line that says, uninsured motorist. Does it say stacked or non-stacked? Or even worse, does it say rejected? This one-line item could be the most important financial decision you make all year. Fixing this gap in your armor is the absolute first priority. But once you've secured that critical protection, we can get back to the fun part. Finding clever ways to chop down your premium without sacrificing quality. There are a series of specific, often overlooked discounts that most drivers are eligible for, but simply don't know to ask about. These aren't the obvious ones like good student or safe driver. These are the discounts buried in the fine print. And we're going to unearth them one by one. Think of this as a treasure map. Your insurance policy is the island, and these discounts are the buried chests of gold. The problem is, the insurance company isn't going to just hand you the map. You have to know where to tell them to dig. Let's start with the biggest, most overlooked category: affinity and occupational discounts. This is the secret handshake of savings. Insurance companies have partnerships with thousands of organizations, universities, employers, professional associations, even certain clubs or credit unions. And if you're a member, you could be eligible for a significant discount, often between 5 and 15%. Are you a graduate of the University of Florida, Florida State, UCF? There's likely an alumni discount waiting for you. Are you a member of a professional organization like the American Medical Association, the National Education Association, or even an engineering society? That's a discount. Do you work for a large corporation, a hospital system, or the government? That's very likely a discount. They don't always advertise these partnerships broadly. It's on you to ask. So here's your first piece of homework. Before you do anything else, make a list. List every college you attended. List your employer. List any professional groups you belong to. Think about fraternities or sororities. Think about military service. Active, retired, or veteran status often comes with one of the biggest discounts available. Think about your credit union. Once you have that list, your first question to your agent is, I'm a member of organization X, Y, and Z. Do you offer an affinity discount for any of them? Don't just ask if they have discounts. Name your group specifically. Force them to check the list. You might be shocked to find out that your membership in a group you haven't thought about in years is about to save you $100 a year. Next, let's talk about the simple, almost insultingly easy discounts that people miss because they think it can't be that simple. I'm talking about the paperless and pay-in-full discounts. Insurance companies are businesses that run on margins. It costs them real money to print stuff and mail you a paper bill every month. It costs them processing fees to handle 12 separate payments instead of 1 or 2. So, they incentivize you to save them money. When you call your agent, ask, What is the discount for going completely paperless with my billing and policy documents? Then immediately follow up with, and what is the additional discount for paying my 6-month or annual premium in full? Combining these two can often shave an instant 5 to 10% off your total bill. It's the lowest hanging fruit on the entire tree. If you can swing the upfront payment, it's one of the best returns on your money you can get anywhere. You're essentially earning a guaranteed 10% return for paying a bill a few months early. No stock market can promise you that. Now let's get into the specifics of your car itself. You probably got a discount for anti-lock brakes or airbags. That's standard. But the list of safety and anti-theft features that qualify for discounts is much longer than most people realize. We need to go granular. Does your car have daytime running lights? That's a discount with some carriers. Does it have a factory-installed anti-theft system? Many people don't even know if they have one. A factory system is different from a third-party alarm you had installed. It's the kind of immobilizer that's built into your key fob. If the correct key isn't present, the car won't start. This is a huge theft deterrent, and insurers know it. That's a discount. What about passive restraint systems? This just means your seatbelts automatically tighten in a collision. Most modern cars have this, but is it listed on your policy? You need to check. Go down the list: electronic stability control, lane departure warning, blind spot detection, adaptive cruise control. All of these advanced driver assistance systems are making cars safer, and insurers are slowly but surely creating discounts for them. The key is that their information about your vehicle's specific trim line might be outdated or incomplete. They might just have you down for a Honda Accord, not the Honda Accord Touring with Honda Sensing Suite. That difference in detail could be a difference of $50 to $100 a year. Your job is to be the expert on your own car and make sure they have every single safety feature documented. Let's move on to you, the driver. We talked about affinity groups, but what about your job itself? This is the occupational discount, and it's based on cold, hard data. Actuarial tables show that people in certain professions get into fewer accidents. They are statistically safer drivers. And if you're in one of those fields, you should be paying less. Who are these people? Teachers and educators are at the top of the list. Engineers, scientists, and accountants are also considered low risk. First responders, police officers, firefighters, EMTs, often qualify. So do doctors, nurses, and other medical professionals. If your job title falls into one of these categories, you need to explicitly ask, do you offer a preferred rate for my profession as an engineer? Or as a registered nurse? Again, don't assume they know or that it was applied automatically. Your job title might be listed as consultant in their system, when it should be certified public accountant. Specificity is your best weapon in this fight. For our drivers over the age of 55 in Florida, there is a gold-plated state-mandated opportunity you cannot afford to ignore: the Mature Driver Course Discount. Florida law requires insurance companies to provide a discount to any driver 55 or older who completes an approved defensive driving course. These aren't complicated, all-day affairs anymore. You can complete most of them online in a few hours from your couch. The cost is minimal, maybe $20 or $25, but the discount is mandatory and it lasts for 3 years. Let me repeat that. You spend a few hours and $25 one time, and you are guaranteed a reduction in your premium for the next 36 months. When that period is up, you simply take a short refresher course and do it again. The return on investment is astronomical. It's one of the clearest, most direct ways for a massive segment of the Florida population to lower their rates. Yet a surprising number of eligible drivers have never even heard of it. Finally, let's bust a myth about bundling. We all know you can get a discount for bundling your auto and home or renter's insurance. But here's the secret level to that strategy. Many companies will give you a discount on your car insurance simply for being a homeowner, even if your home isn't insured with them. Why? Because once again, the data shows that homeowners tend to be more stable and risk-averse than renters. Owning a home is a signal to the insurance company that you're a responsible, long-term planner. It makes you a more attractive customer. So, when you're on the phone with your auto insurer, and they ask if you want to bundle, you might say, "Not right now, but you should know that I am a homeowner. Is there a discount for that?" You might be pleasantly surprised by the answer. It's a way to get some of the benefit of a bundle without actually having to switch your home insurance policy. So you see, these discounts are layered. They're hidden in your profession, your education, your memberships, the very safety features of your car, and even your status as a homeowner. By systematically going through this checklist, you are taking control. You're no longer just accepting the price you're given. You're actively building a case for why you deserve to pay less. But this brings us to a fundamental, and frankly frustrating paradox in the insurance world. After you've done all this work, after you've uncovered every possible discount with your current company, you have to ask one final critical question. Is the loyalty they're showing you with a tiny long-term customer discount worth more than the massive new customer discount their competitor is offering to steal you away? You've now made your current policy as lean and efficient as possible. But what if the entire foundation is still more expensive than starting fresh somewhere else? This is the ultimate dilemma, and it's the final piece of the puzzle we need to solve. So let's talk about the single most powerful, and yet most underutilized weapon in your entire arsenal: shopping your rate. Sounds simple, almost too simple. But the reality is, the vast majority of drivers don't do it. They get comfortable. They assume the loyalty discount they're getting is the best deal possible. But I'm here to tell you a hard truth. In the world of insurance, loyalty is often punished, not rewarded. It's a phenomenon called price optimization. Insurers know that once a customer has been with them for a few years, they're less likely to leave. Life gets busy, it feels like a hassle, and you trust them. So, year after year, they might inch your rate up just a little bit at a time. A few dollars here, a $10 increase there. It's a slow boil, and you're the frog in the pot. They are betting on your inertia. They are counting on you not to check. Today we call their bluff. Shopping for insurance isn't just about finding a cheaper price. It's about resetting the entire market in your favor. It's about forcing companies to compete for your business, not take it for granted. And we're going to do this with a methodical three-pronged attack that ensures we see every possible option. Before we launch the attack, we need to prepare our intelligence. You've already done the hard work in the previous parts. You have your current policy's declaration page. You know exactly what coverage you have, right down to the dollar amount for bodily injury, property damage, and your exact deductibles for collision and comprehensive. This is your baseline, your control in the experiment. Do not start shopping without it. Quoting random coverages will give you useless, apples to oranges comparisons. You need to quote the exact same coverage everywhere to get a true measure of the price difference. Okay, intelligence gathered. Let's begin the attack. Prong 1 is the digital blitz. This is where we cast the widest net possible with the least amount of effort. We're going to use independent insurance comparison websites. Think of tools you see advertised like the Zebra, or financial advice sites like NerdWallet and Bankrate that have built-in comparison engines. Your goal here is not to find the final answer, but to get a quick snapshot of the landscape. You'll enter your information once, and it will pull quotes from a dozen or more different carriers. In 10 minutes, you'll have a list of potential contenders and a general idea of what a competitive rate looks like for someone with your profile. But, and this is critical, do not stop here. Many of the largest and sometimes cheapest insurers don't participate in these aggregator sites. They want you to come directly to them, which brings us to our next move. Prong 2 is the direct assault. Take the top 2 or 3 names in insurance that did not show up in your digital blitz. You know who they are, the ones with the massive advertising budgets. Go directly to their websites. Yes, this means entering your information again. It's a bit of a pain, but we are on a mission. The 5 or 10 minutes it takes to fill out another form could save you hundreds of dollars. These companies often have incredibly sophisticated quoting algorithms on their own sites that can offer a better price than what they allow aggregators to show. You are now comparing the big net results with the direct from the source prices. You should start to see a clear winner or two emerge. But we're still not done. We have one more, and arguably the most powerful weapon to deploy. Prong 3 is the human element, the independent agent. This is the secret that separates the amateurs from the pros. While an agent at State Farm works for State Farm, and an agent at Allstate works for Allstate, an independent agent works for you. They are a broker. Their job is to represent you to a multitude of different insurance companies, many of which you have never even heard of. These are often smaller, regional Florida-based insurers that don't have $1 billion ad budget. They compete on price and service alone. Find a well-reviewed, local independent insurance agent in your area. Call them. Tell them, here is my current declaration page. This is the exact coverage I want. Can you beat it? Then be quiet and let them work their magic. They have access to quoting systems and companies you will never find online. They can often find unique discount combinations that automated systems miss. This single phone call can uncover a hidden gem that saves you 40% more than anything you found on your own. Now the battle is over and the dust has settled. You should have a clear winner. A new quote that is significantly cheaper than what you're currently paying for the exact same coverage. This is the moment of truth. This is where we execute the final gambit. You're going to make one last phone call to your current insurance company. This is the retention department call. It's a calm, polite, but firm conversation. Goes like this. Hi, my name is, your name, and my policy number is, your policy number. My policy is coming up for renewal, and I've been shopping around to ensure I'm getting the best rate. I've been a loyal customer for a number of years, and I'd really prefer to stay with you. However, I've received a quote from new company name for the identical coverage I have now, and their annual premium is the new lower price. That's a difference of, calculate the difference per year. I was calling to see if there's anything you can do to match that price, or at least get closer to it before I make my final decision. And then you wait. You have just done something 99% of their customers never do. You've presented them with concrete data. You've been polite. You've expressed a desire to stay, and you've given them a clear target to hit. Sometimes they will say no. Their hands are tied, the computer says what it says. But you would be absolutely shocked at how often a manager can suddenly discover a new discount you were eligible for. They might find a special retention credit, or rerun your profile and find a better tier. They may not match the price exactly, but they might get close enough that it's not worth the hassle of switching. Or they might match it completely. Either way, you win. If they lower your rate, you just saved hundreds of dollars with a single phone call. If they refuse, you switch to the new, cheaper company with a clear conscience, knowing you gave your old one a fair shot. You make the switch, get your new insurance cards, and then, and only then, do you cancel your old policy. This entire process, from the digital blitz to the final phone call, might take you 1, maybe 2 hours out of your entire year. But for those 2 hours of work, Floridians who follow this strategy routinely save $500, $1,000, even $1,500 a year. There is no other way to work for 2 hours and get that kind of return on your time. We've come a long way. We started by understanding the chaos of the Florida market. We took control by optimizing your driver profile and vehicle choice. We dug deep into every possible discount. We tailored your coverage to be a suit of armor, not a bloated costume. And finally, we forced the entire market to compete for the honor of protecting you, ensuring the foundation of your policy is built on the best possible price. You are now armed with more knowledge than 99% of the drivers on the road. The power is no longer with the insurance companies. It is with you. The only thing left to do is act. Take this knowledge, follow the steps, and reclaim your money. Stop overpaying for a service you are legally required to have. Fight back against the Florida insurance crisis, one policy at a time, starting with your own.